was in demand, which was the higher-end iPhone 14 Pro and Pro Max models. What they're seeing in management of supply chain is they are having issues with other products.
January 27th. Now, talking about difficult times, Southwest. We're told the airline is returning to its normal schedule as it processes refunds. That stock is down another 0.6%. Abby, what a tough ride.
Yeah.
Passengers, never mind the company.
Absolutely, John. And Happy New Year to you. And I bet it's starting off a lot better than it would have had you been on book for one of those Southwest flights. Of course, it's a domestic airline, not affecting you. But tell that to the tens of thousands of people stranded, both passengers and crew. Nearly 16,000 flights were canceled between December 22nd and January 1st. To give you a sense of the magnitude for the company going beyond the blizzard, their technology, their outdated technology, American was the next with the most canceled at just 838. Now, of course, we are getting back to more normal travel now. You were mentioning that earlier in the pre-market, the stock had been higher. Today, about 34 flights have been canceled, about 170 delays. But still, Bob Jordan, the CEO, said that there's almost no way to apologize enough. They are, of course, getting some money back to customers, reasonable expenses. But tell that to the bride, John, who missed her wedding. She had to postpone her wedding and then spent New Year's Eve alone in the airport, or to folks on Christmas who were almost arrested for trespassing in the airports that they were left stranded in. Tough times. These delays and cancellations will look worse because flights are almost back to pandemic levels. That's not true for the stock, though, John. The stock is almost down about 50% from its pre-pandemic high, and over the course of these delays, this debacle really, down about 9%.
Brutal, absolutely brutal. Abby, thank you for that. Citi Stuart Kaiser looking ahead, gearing up for earnings season. That'll kick off unofficially, of course, with JP Morgan on the 13th, so that's next Friday. Fourth quarter S&P 500 earnings will be a key barometer for equity bears. Soft earnings and negative guidance are expected/required of the bear case, leaving surprise to the upside from earnings, especially for tech. Stu joins us right now. Stuart, wonderful to catch up with you, sir, as always. Let's start there. Are you saying that we should play that, look to position for that opportunistically, that maybe you get that kind of upside surprise, particularly in tech?
Hey, good morning, John, and Happy New Year. Look, I think it's something that's on our radar. We probably want to give it a couple weeks here just to see how the year starts. I think it's just, though, a symptom of the broader malaise in the market, right, where the sell side consensus is extremely bearish, expecting negative earnings revisions and a disappointing earnings print. So that just kind of sets the bar much lower, and with the index now at 3850 instead of 4,000. It also kind of resets the bar a little bit lower. So I think when we think of risk reward around earnings, I think your downside risk is probably coming much more from the banks and the discretionary parts of the market. And frankly, your upside risk might come from tech, just because expectations are so low there that I think it's a pretty low bar for them to surprise on the positive side.
Stu, just when it comes to earnings season and the arc of earnings season, the banks go first, tech much later in the earnings season, then retail at the back end. What would you look for? Where would you look for signal for what you expect to see in the economy in the year ahead?
Well, I think you hit it right on the head there with JP Morgan starting off earnings in 2 weeks. I think the banks are probably going to speak very directly to the level of activity they're seeing in consumer spending and in lending, and I think that'll be much more of a macro takeaway from earnings will come from the bank sector, and I think that's where we'll get kind of the clearest update on the economy. To your point, we don't get that retail data till probably till the middle of February basically. So it's going to be first banks, and then we move on to the more idiosyncratic and kind of margin story from tech and healthcare.
Stu, how defensive do you think the banks are going to be in 23, given the shifts we've seen in that business model over the last 10 plus years?
I would expect them to be very conservative in their commentary. A lot of the CEOs have been on the tape the last month at various conferences and speaking engagements, also speaking with our analysts directly, and they've been, they've definitely guided down expectations, and I think they're trying to highlight the downside, kind of risk to the economy and to their numbers. So I would expect them to continue to do that. You might argue some of that was, also related to compensation in the bank sector as well. So just, kind of a lot of sort of negative news, and I think resetting of expectations coming from senior management across a lot of U.S. banks, and I think that probably continues.
Do you think it's odd, Stu, that when you listen to conversations on programs like this one, and maybe Bloomberg Surveillance as well, that you see people lining up, almost itching to price a recovery to a recession that hasn't actually developed?
Yeah, I think that was the case in early December. I think the last 2 weeks have been quite a bit different. I think The Fed really, took the wind out of those sails, I think, right? To your point, I think in early December, the market was rallying. Folks were saying, the peak of inflation is behind us. It's going to be a shallow recession, and we kind of want to pre-trade that story. But, what the Fed did is it kind of drove a stake through the heart of that, because they essentially said, we're not comfortable with inflation. We don't like financial conditions where they are, and we're willing to sacrifice a recession to get inflation lower. So I do think that optimism was there, but I think it got eroded, pretty strongly in the middle of December, and that's why we've traded so poorly into year end.
Well, energy names didn't trade poorly, that's for sure, and you know that. That's where the outperformance, the leadership was through 2022. Energy on the S&P, that segment up 59%, Stu, last year. Is it too early, too premature to make calls on leadership for the year ahead?
Look, I think there's two, questions embedded in that. Tactically speaking, you tend to see a very strong rotation out of market leaders very early in the year, and that's been about a 9 out of 10 years in the last 20 or 30 years. You've seen sort of leaders from the previous year underperform to start the year. In terms of, what's going to outperform, the next 3 to 6 months, I'd kind of say your guess is as good as mine at this point. In terms of energy specifically, I think there's a China global growth impulse, which you touched on, and then there's a depth of U.S. recession. And I think those two things are going to largely determine, whether the energy sector performs well. If you get a shallow U.S. recession and China's reopening in the background, I think you could argue for, continued commodity prices higher. If that recession in the U.S. looks like it's going to be deeper, I think that creates kind of a difficult sledding there for energy going forward. From my perspective, our view is to remain pretty cautious and pretty conservative here early in the year. Higher quality stocks, places you can kind of hide out, stocks with very clear kind of idiosyncratic, product or company-specific stories that can weather kind of a recession to start the year is where we would point people to.
Stuart Kaiser, awesome, as always. Looking forward to working with you in the year ahead. Stuart Kaiser there of Citi. Thank you, sir. Equities right now up 0.8% on the S&P, about 10 or 11 minutes into the session on the Nasdaq, up by 1.2. Coming up, Blackstone's Real Estate Trust getting a fresh $4 billion cash injection. A conversation with Blackstone President and COO John Gray sitting down with Sonali Basak up next.
To our worldwide audience on Bloomberg Television and on radio, I'm Shonali Bassick. We're joined by Jonathan Gray, Blackstone's president and chief operating officer now. Jonathan, you're coming off this $4 billion investment from University of California Regents. A lot of this is for BREIT. It is for your Crown real estate fund, a lot of retail investors in it. $4 billion is much bigger, obviously, than the typical retail check. But this is coming after a wave of redemptions as reported over a period of time. So what is the $4 billion really accomplishing for you at the end of the day? Is it filling the hole from these investors, or is it giving you something new to do?
Well, Shonali, Happy New Year. I'll just start with a little bit of background here because this is a big win for us. It's a big win for BREIT. It's a big win for the University of California, who's making this investment. $4 billion of common stock into BREIT with a minimum effective hold period of 6 years. It is a massive affirmation of the quality of the portfolio we've constructed, of the values of the assets here, and the performance outlook. All of that, of course, is quite good for our investors. And this is something that came about really because of the news media telling this story on BREIT. In many cases, we disagreeing with that. And Jagdeep Boucher, the longtime CIO of the University of California's $150 billion investment fund, reached out and said, hey, is there something we can do together? We came up with a mutually beneficial structure, and then he and his team spent the last few weeks seeing real estate, looking at our portfolio, meeting with our portfolio company CEOs, understanding valuations, liquidity, and as a result, getting very comfortable in making this large-scale investment. So I think the biggest thing here is just a validation of BREIT, particularly given all the noise out there and some of the what we think of as incorrect analysis. In terms of what we do with the capital, well, we have a lot of options. We've obviously got a dislocated market out there, which creates opportunities. Some investors are seeking redemptions, although it's much smaller than I think the media has indicated. In fact, in December, after 8 weeks of negative press, we had just 3% of U.S. investors looking for redemptions, 5% of all of our investors, but some capital can go to that. We've got a lot of options, and it's nice to be in this position today, particularly after enduring some of this that we didn't enjoy, and now being able to clear the record and have a major investor so sophisticated come in at scale.
Hey, John, you know, one thing about this investment, as far as the terms go, they do have a preferred minimum return that they're going to be getting. It's something that's guaranteed to them. Why wouldn't another average investor look at this and say that's preferential treatment?
So the way to think about this transaction is they're actually coming in as a common shareholder at the BREIT level with this $4 billion fresh investment. They're taking that investment, and then we're taking $1 billion of our existing holdings and putting it in this strategic venture. It does give them a minimum return. It gives us some upside participation. But I think the things to keep in mind are, one, the validation I talked about, and two, just like in our large institutional funds, big investors do get differentiated consideration. So if you think about it, their investment here is $4 billion. A typical BREIT investor is $70,000. A typical investor can seek liquidity beginning a month after their investment. Here, effectively, it's 72 months after their investment. And so these things are very different fundamentally, and the additional considerations coming from Blackstone, they're actually paying the full fees that any of the traditional BREIT investors are inside the vehicle. So we think, as we said, a big affirmation and a real positive for BREIT.
You know, it's interesting because BREIT's own performance last year outstripped the market pretty meaningfully here, more than 8%, over 3 years, almost 15%. But the question here, too, I have is last year hedges really helped the portfolio. Do those hedges start to subside in performance this year? And what is the thing that will bring you upward this year?
So I think the key when you look forward and ultimately is the performance of the assets. You're correct that we did get a big boost from the hedges we put in place. We hedged out the debt for 6.5 years smartly when rates were lower, when we were concerned about inflation. That gave us about $4 billion of value gains. It was very helpful. As the long end of the curve comes down, we won't have the tailwind from that, but we will have the tailwind from potentially lower long rates helping the value of this $130 billion portfolio. And over time, that should be quite beneficial. The other tailwinds here are the rents in place in the portfolio are about 20% below market. The market rents have continued to grow despite the economy slowing. They were up in this portfolio 10% in November. And then longer term, what we expect to see is a lot less new supply. You've seen it in the housing market. I think you'll see it in the logistics space as well. Those are our two big holdings, as you know, in BREIT. And less supply is key because ultimately the value of real estate is driven by supply and demand, and that gives us a lot of confidence as we look out over the horizon.
Do you see more opportunities? You had some meaningful sales last year. Do you think that there's more opportunity to sell into this market, whether it's because of market pricing or something else? Would it help you really build the value of this portfolio to do that?
Well, I think that's one of the tools. I would say the most liquidity in real estate today is in the rental housing space, multifamily apartments, and we have been selling some assets there. We'll probably continue to sell some. Other areas, there are opportunities. And I think one of the important things, Shonali, people think about BREIT as a real estate portfolio, but had we owned for sale housing or had we owned office buildings, it would have been much tougher. And so I think there'll be opportunities to sell in some sectors and hopefully some good opportunities to deploy capital also.
John, before I let you go, about 30 seconds or so here, victory lap for Blackstone. You guys were so early when you had predicted that interest rates would go much higher than anyone had thought. Joe Zeidel said as high as 5%. And that was when banks were still saying 3%. So where do you think they go this year? Do you think that the expectation of cuts makes sense?
So it's always dangerous getting into interest rate predictions, but what I would say is, given the fact that inflation is starting to come down, particularly in things like shipping costs, commodities, the labor market is cooling a bit, but is still too tight from the Fed's perspective. I do think the Fed will stop raising rates in the first half of the year, but my expectation would be they would hold rates at those levels through the balance of the year, even as the economy slows. I think the long end will stay inverted because people will think over time the Fed will cut and the natural rate of interest rates lower. But I think for the year, we'll get to this level somewhere around 5 or low 5s. The Fed's likely to hold there and the long end to be at a lower level given the expectation of a slower economy.
That's Blackstone's president and chief operating officer on the heels of a $4 billion deal. John Gray, thank you so much for your time. John?
Shonali, great work. Thank you. As always, we'll catch up with Shonali through the day on Bloomberg TV and radio. Just want to get your attention over to Tesla. That stock, session lows. We are down by more than 8 full percentage points. Let's squeeze in some sector price action as well. Here's Abby.
Well, here's something, John. We're actually looking at above average volume here. For a small gain at this point, the S&P 500 up about 0.2%. But what really stands out on the day, we are looking at last year's best sectors. Well, they're on bottom. That, of course, energy, consumer staples, healthcare and utilities. Discretionary has squeezed into there on that Tesla. Up top, we have communication services up 1.4%. Let's see whether or not the Santa Claus rally can continue. John, right now up about 0.6%, really being helped out by some of the China tech and other tech names.
Abby, thank you. Equities doing okay. Tesla, not so much. We'll continue covering that story through the day on TV and radio and through the week right here on The Open. Up next, your trading diary, the path ahead into payrolls this Friday. 26 minutes into the session, 26 minutes into trading for 2023. Happy New Year. Good morning to you. Equities now totally unchanged after popping higher around the opening bout about 25 minutes ago, 26 minutes ago. We fade on the Nasdaq as well. That's the price action. Let's get you the trading diary. ISM manufacturing and US JOLTS data coming up on Wednesday. The Fed minutes at 2 p.m. Eastern time on the same day. More jobs data on Thursday, another round of jobless claims, plus service PMIs in the United States. And finally, the big one to round out the week is the payrolls report on Friday from New York City. Thank you for choosing Bloomberg TV. It's good to be back in a seat. Happy New Year to you all. This was the countdown to the open. This is Bloomberg TV.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the first U.S. trading day of the year, Tuesday, January 3rd. Here are the top market stories we're following for you at this hour. What can go wrong in 2023? Equities try and cling on to their rally. Yields tumble. Markets reset. And we talk through the biggest risks in Europe as well as the U.S. And Tesla tumbles. Stock kicks off 2023 with a big bust as deliveries miss estimates, capping the worst yearly performance since its IPO. And China's COVID crisis. Cases explode. The country vows to hit back at other nations imposing travel restrictions while more people start taking the subway. We try to find the peak with Dr. Gregory Poland of the Mayo Clinic. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Happy New Year, Guy. One of my resolutions is to not get COVID this year. I don't know if that's going to work.
That sounds like a fantastic resolution. I don't know whether it's in your power or not, but we'll wait and see. I'm not even sure it's going to be a happy new year. This time last year, where were we? No way did we predict that we were going to be having a major land war in Europe, that we were going to be having an energy crisis, that inflation was going to take off. So I think asking the question about what this year is going to bring, I think, is a tricky one from the get-go. Is it going to be a continuation of 2022, 2023, or is it going to be something completely different? I simply don't know. I think it's a real wild card, 2023. I don't know what's going to happen.
And also what winds up being priced in. Like if we're priced for a rebound in the back half, or already priced for a recession, would the side of, hey, things aren't that bad, be actually what really rocks markets this year? I don't know. I think it's going to be really interesting.
Surprises can be positive as well as negative. We just happen to have had an awful lot of negative ones. And there's a lot of unanswered questions at the moment. So there's definitely potential for things to maybe go a little bit off course. So our question of the day, as Alex has already said, what are the biggest risks for the US in 2023? Joining us now from Washington, D.C. is Bloomberg's Mike McKee. Also with us, Ira Jersey, Bloomberg Intelligence's Chief US Rates Strategist. Mike, let me start with you. What do you think 2023 actually looks like? As you come at it from an economist point of view, what are the biggest risks that you see that investors have priced but not completely understood?
I'm glad you used the plural of risks there, because I think there are several rather than just one. The overhanging risk is what Ian Bremmer of the G7 folks put out today in their annual risks ahead for 2023 list, and that is a rogue Russia. I don't know what could happen with them, but it hangs over everything because of energy and because of food. So that could be a major issue. But I think the things that we know about at this point, the biggest is going to be the Fed. The consensus is we're going to have a recession at some point this year. And I think the risk is that it is a mild and slow forming recession, which means the Fed won't recognize that it's happening at the time, and it would take longer to react to it. So a Fed that's already determined to keep rates higher for longer this may be a risk that they send us into a deeper recession. One other thing I would mention that's probably the gray swan, the thing that everybody knows is out there but doesn't think is going to happen. What if the Republicans actually do force a debt ceiling showdown and something happens there? That could be a real issue.
Yeah, no, definitely, Mike. We're going to talk about that later on in the show as well, in terms of what Kevin McCarthy, as Speaker of the House, if he gets there, means for that exact conversation. Hey, Ira, what's your call? Biggest risk for this year in the U.S.?
Yeah, so something that Mike didn't mention, and I agree with most of what Mike said as far as the risks go, but I think it winds up being a different exogenous shock. So, and there's probably ones on each side of the spectrum. So one is that something else does happen with Russia, that we do have, or we have another problem in the Middle East that winds up shooting up oil prices again. And I think if that happens, then the inflationary impulse that has slowly been easing over the last 6 months or so could actually reaccelerate. And I think that's something that most people don't expect to happen, but I think that's a real risk and something that that is a tail event that we can't completely discount. And then on the other side, it would be something, even a deeper recession that maybe we're already starting to see the beginnings of right now, that winds up being somewhat deeper and earlier than we thought. Now, that's not our base case scenario, but I think that is, again, one of the risks that could wind up pushing, maybe equity markets down a little bit, and certainly bond yields down a lot faster than we think that they'll come down.
Okay, well, let's talk about that a little bit more. Ira, the big story for 2023, if you listen to people that come on the show regularly, strategists that talk about the market, is that we're going to see bonds doing well. What is the risk to that trade?
Yeah, I think the risk to that trade is that inflation doesn't actually fall, that we actually get a stabilization in a lot of the inflationary measures close to current levels. And the real thing that such a move would do would be to have, say, Fed funds futures and SOFR futures and the other rate markets would wind up probably selling off quite a lot in the further out quarters. So that would mean that you can wind up with 5-year notes staying where they are instead of rallying rallying significantly. Now that being said, Guy, there's almost no realistic scenario where bond yields do as badly as they did last year. I mean, there's a lot of technical reasons for that, but you could wind up seeing maybe flat to slightly down returns if you wind up with, say, 10-year yields going up to 5%, for example. And that's again, I think a tail risk, but certainly not one that's completely out of the question if you wind up seeing a significant inflationary impulse.
Hey, Mike, is the QT risk, is that going to be a 2023 story or a 2024 story?
I don't know how much of a risk it's going to be. Last time the Fed let things go, and then at some point they broke something and they said, okay, we're going to stop. This time they say they're just going to pick a random time and stop, which I would think would come towards the end of this year. So if we don't see any negative reaction ahead of time, I think probably that's going to be one of the lesser risks for 2023.
Mike, picking up on what Ira said a moment ago about inflation and the potential for inflation to stabilize kind of where we are now, how big a risk is there that the Fed doesn't get a grip on inflation?
I don't think there's a huge risk that they don't. It's a question of timing. The Fed can do whatever it wants to the economy by raising interest rates. They can put us into a full depression if they wanted to. So they can kill inflation. It's a question of how long it's going to take to do that. And that's going to really depend on how things develop in the labor markets, because what they are seeing now is inflation driven by wages in the service sector because there aren't enough employees. So we'll be watching the payroll reports very closely to see what happens in that area. And what the Fed would do is raise interest rates until companies stop producing as much because they get scared, and then consumers get scared. So maybe you could sum up that risk as the old Franklin Roosevelt quote, the only thing we have to fear is fear itself.
Guy, I have a thing for you. I have a budget. I have a weekly spending budget now. I'm just saying, if I can hold to that, this is a big deal when it comes to consumer spending. I'm just...
Well, okay. We should just talk about that budget for a second, though. What is included within that budget, I guess, is fairly important detail.
Solely discretionary, shoes, clothes, coats, just pure shopping discretionary budget.
All right. Okay. So this isn't a grocery budget. This is a nice-to-have budget.
Yes. So
well, I'm glad you're constraining yourself.
But we say this because it's a big deal when it comes to actual spending, and if I'm a barometer to spending, I think
Alex is doing that. I think Alex is doing this because we may joke about her shoe habit quite regularly on this show.
All right, guys, we're going to leave it there, but we appreciate it. What the consumers spend and how they spend, I'm telling you, that's going to be the thing of the next 6 months. Mike, Ira, really appreciate it. Thank you both very much. Happy New Year to you both. Coming up, we're going to continue that conversation more on the question of the day and the risk of recession, where the biggest risk is. Katrina Dudley of Franklin Mutual Advisors will be joining us. And as we head to break, Ian Bremmer of Eurasia weighed in with his biggest risk for the global economy in 2023.
The global economy has never experienced anything like that. That level of uncertainty in the persona of one human being. We've seen it with the decision to do a complete 180-degree volte-face with the pandemic and zero COVID. We've seen it with $1 trillion off of market value of Chinese tech stocks because Xi Jinping decided that he was going to squeeze them. That level of uncertainty as China reopens their economy this year is an enormously concerning issue.
It's the first jobs report of the new year.
The labor market has not cracked.
A lot of that's a function of labor shortages.
This Friday, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
Can you walk us through how the Federal Reserve conversation has reset?
We're still seeing a strong economy, so the Fed has to do more.
Why are people so confident that there is going to be some massive deceleration?
I just don't see the evidence. This could go a lot of different ways.
The December Jobs Report, Friday on Bloomberg Television and Radio.
Recession is pretty likely just because of what the Fed has to do. But what's different this time, I think, is that if we have a recession, it's going to be a Fed-induced recession. And the Fed can end the recession by subsequently easing monetary policy. The challenge for them is to not ease too soon.
That was former New York Fed President and Bloomberg Opinion contributor Bill Dudley on the risks of a U.S. recession this year. Which leads us to the question of the day: what is the biggest risk for the U.S. economy in 2023? Joining us now, Katrina Dudley, investment strategist and portfolio manager at Franklin Mutual Advisors. Katrina, good to see you. What's your biggest risk?
Look, I think that the risks that we've got in 2023 are similar to some of the risks that we've seen in 2022. Inflation is the big one, and Fed is the other one in terms of, the pace at which they've increased rates over 2022 has been very significant, and we need them to kind of step off that gas pedal and let the economy catch up.
Katrina, Happy New Year. In terms of how you would handicap the recession risk right now, what does it look like? Do you expect a recession? Do you think we can avoid a recession? What are you preparing for?
Look, we can sit here and debate the tightrope that you're talking about. Do we go into a recession or do we not go into a recession? But the key is how deep is the recession that we go into if we do go into one. And even if we do, we're in the camp that it's going to be mild. You have a look at the market. We don't have excess in supply here. We've actually had very tight supply in a number of markets. We look at the jobs market and we're talking about this being a job-filled recession, not a job, loss recession. So I think even if we do tip into a recession, it will be a slight tip, and it is going to be very mild, much milder than people are talking about.
So it does feel like there's two camps, though, Katrina, that are evolving. That you have, though, stubbornly high inflation and then more rate hikes from the Fed versus a recession and a higher rate for unemployment. Are you more with the first one? How do you see those two situations evolving?
I think in terms of the level of inflation, that's the really key issue here. Stubbornly high inflation in the high, single digits, we do not support that. But we do think that the Fed is going to struggle to get it back, right back to its 2% target. We think probably 2-3 is more the new normal here as we look going forward. We like that level of inflation because it's in a level of inflation that people can price for. And that's the key issue with this inflation. If you've got a business model where you've got predictable inflation and you're able to price it for it, and you've got the resources to be able to meet demand, you're going to be fine, even if you have a slight recession and a slight lessening in demand. And it's actually why we're overweight industrials, because we think that that is one sector where people are pricing in this big recession and we just don't see it.
Katrina, where could you be wrong? Where are the tail risks in your theory?
I think the biggest area of tail risk is this war in Ukraine. So if we go over to Europe, interestingly enough, I talk about it that if you had that forward newspaper at the beginning of last year, and I told you you're going to have a spike in energy prices and a war and a spike in food inflation, you would never have predicted that Europe would outperform as a market, and it has. So if I take a look at that war in Ukraine, it's really the market has been very benign in terms of handling that. If we see a real spike in tensions there and we see some real irrational actions, that is the one risk that I am very concerned about. I'm also concerned about how that then plays into the China situation, because I think those are the two big risks. They're very geopolitical. It's not as much about things that companies can control, and they're the type of risks that we really don't like.
Katrina, when it comes to China, is that conflict with the West over Taiwan, or is it reopening bumps, or is it the property sector? Where in China is that risk?
I think that the big risk that we see as the big surprise is Taiwan, and any action that you could potentially have with China over Taiwan. Obviously, we've had action on the semi side. On the reopening side, I think that China is finally doing the right thing. And so from a perspective and an equity investor, we're just really concerned about the outsized risk of something happening in Taiwan, because that is something that companies really can't do anything about.
The real kind of hit last year came in tech, Katrina. That was the bit that nobody predicted. Nobody predicted rates were going to go higher. Nobody predicted that tech was going to be as slammed as it was. Why do you like tech in 2023?
Okay, so you need to understand why tech underperformed so much last year. And I think you need to understand the impact of those rising interest rates, and that is that discounting mechanism. So what we saw is a lot of damage that was done in those out years and discounting back those cash flows. It started in the profitless tech and then it moved into tech. The areas that we like are, areas of the market where you've had a very, very significant decline. And I think that people are focusing on area A, or an area, say, where a company is over-investing and they're not focusing on underlying business fundamentals. And the reason we think that that's the opportunity is that these tech investors really haven't had to focus on business fundamentals for a long period of time. They've been riding this lower inflation rate cycle and riding the rise in stock prices has come as a result of that. So tech investors are now actually having to do the work that we have been doing, as active stock pickers our entire career. So that's why we think there's a lot of opportunity there, but you really need to be stock pickers. I think that that's the key message. You can't just take this blanket paintbrush and go, I'm going to go all in tech. I think that you really need to choose your spots.
So does that mean that value can still outperform, or do we need to not look at stuff value versus growth anymore?
I think that the definition of value as we've perceived it in terms of low price to book and low price to earnings multiples is really not the way to define value going forward, just given the changes you've had in accounting rules, the creation of a lot of assets that don't sit on company balance sheets. But when we define value, we're looking at a couple of things. We're looking at what is the forward cash flows of these businesses and how is the market discounting those. And if we think that a stock is trading at a substantial discount to those, we're going to be looking at that as a value stock. We will look at those traditional metrics, but I think that taking that kind of very strict quant approach to value is not going to work in this market going forward.
Katrina, fascinating to hear you say that tech investors are going to have to do some hard work. It's not going to be a one-way street. I think we learned that last year. We're now certainly seeing it in Tesla today. Tesla's getting absolutely slammed. We're going to be talking about that next. Katrina, really useful. Thank you very much indeed for setting us up for 2023. Katrina Dudley of Franklin Mutual Advisors. As I say, up next, tough tape for Tesla. Look at what is happening with the shares now. That's a two-day chart. We're down by 9.23, down circa percent, I think, on the day. Delivery estimates missed in the last quarter. Worst performer in the S&P. More on that story next. This is Bloomberg.
Time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Ritika Gupta. The University of California is investing $4 billion in the massive Blackstone Real Estate Income Trust. The fund has faced higher redemptions in recent months and has been forced to limit withdrawals. That's raised concerns about Blackstone's growing reliance on mass affluent clients as opposed to institutional investors. In China, Foxconn has brought the world's largest iPhone plant back to about 90% peak capacity. That suggests that Apple's biggest production partner now has enough workers despite a COVID outbreak and a staff upheaval. In November, thousands of workers at the facility either left or staged protests against extreme COVID restrictions. And it will cost you more to buy a Rolex in the US and the UK. The Swiss luxury watchmaker raised its prices in the two countries by an average of about 2.5%. The latest increase shows Rolex believes it can lift prices to protect its margins without hurting demand. And that is your latest business flash, Guy.
Ritika, thank you very much indeed. Watches of Switzerland certainly performing quite well today in London. 7:20 on the West Coast. Let's get set up for the startup, covering the latest tech stories out of the Bay Area and beyond. Silicon Valley gets ready for the morning ahead. The story's already fairly clear. Joining us now, Bloomberg Technology co-anchor Ed Ludlow. Ed, talk me through this Tesla move. It is ugly. Yeah. In what way should we be reading this move? Is it about demand? Is it about supply? Is it about an inability of this company to convince investors that it is now different? I'm wondering how we should look at this.
Well, look, a number of sell-side analysts have cut price targets, and they do reference the idea that there is a demand problem here. You know, this was the third consecutive quarter where Tesla missed on delivery estimates. I think that the key thing is because it was the final 3 months of the year, they missed that average annual growth rate target of 50%. You know, they were close. I think deliveries were up 40% year on year in 2022, but not close enough. And, you know, a number of analysts kind of cite the actions that Tesla took in those final few weeks of the year, including, you know, bringing back that $7,500 incentive in the US, price cuts in China, and all roads in their conclusions lead to this being a demand issue. I would say that Tesla did point out that it's continuing to have a more even mix of production and delivery, right? So it's not all about the US and not all about China. You know, Berlin is growing, Austin's growing, but that meant more vehicles were caught in transit, which is something we've heard before.
So Ed, it's easy to say this is just really a Tesla thing, but then I look at something like Apple falling below $2 trillion in market value, and I have to genuinely wonder what the macro signal is from here. Is it just still the re-rating of tech in general?
Well, you know, the Apple story seems to be a demand one as well. Nikkei is reporting that Apple has asked its suppliers for fewer components for AirPod and Apple Watch. You know, the read-through being, or inference being, that if they're asking suppliers for fewer components, they plan to build fewer units because demand may not be there. Theirs is also a supply story, right, just as it is with Tesla, in that supply has been impacted in China in particular because of the spread of COVID-19, and earlier, you know, the restrictive COVID zero policy, which has now been removed in China. So, you know, they're kind of getting hit on both sides. The question is as well is that, you know, I think that your last guest put it pretty well. It's time for tech investors to start, you know, paying attention to the fundamentals, and there's still a question of where the terminal rate for the Federal Reserve is at the end of this year into next year. That's a big part of the technology sector.
Yeah, maybe they've got to do the work, and maybe they're not going to like what they find when they do that work.
Right.
Ed, are these companies both examples of the halo effect starting to fade? For a while, Tesla could do no wrong.
Yeah, I mean, at the beginning of this year, when things were hard, people said, look at the strong balance sheet, look at the incumbency of the market position of these players. That's kind of gone out the window. They're not immune to macro effects, and what we're seeing is the investors react to that in selling the shares.
All right, Ed, good to see you. Happy New Year. Great to see you back in San Francisco. I know a guy's sad about that, though. Ed Ludlow, thank you very much. Coming up, we're going to turn to a risk that actually Mike McKee brought up at the top of the show. A new Congress gets sworn in today. The Speaker of the House position still up for grabs. We're going to talk about what this means longer term for policy with Henrietta Trace, Beta Partners Managing Partner. This is Bloomberg. We are about an hour into the first trading day of the U.S. session here in 2023. Abigail Doolittle tracking the moves. We're really rolling over here, Abigail.
Yeah, it's turning kind of brutal because earlier when I first came in, we were up pretty solidly. It looked like 2023 was going to start to the upside. It did, but we are, to Alex's point, rolling over. It's on volume, too. Volume, last time I looked, about 20% above the anemic level. And I think we have two things going on. From a macro standpoint, we have the Bloomberg Dollar Index higher. That, of course, pressures stocks. But we also have Tesla down about 9%, about 10%, really close to support after record deliveries. But that missed Wall Street estimates, I would say that Tesla is a good risk-on, risk-off sentiment indicator. Holding out of support, we'll probably take a look at a chart of that company, that stock, at some point in the near future. But right now, weighing on markets. What's interesting is that we do have what should be a macro tailwind, but it's not. You have the Bloomberg Dollar Index down. But if we go into the Bloomberg Terminal, we will see yields are also down. Typically, at least in 2022, that would have been a good thing, not just for stocks, but especially tech. It's simply not the case. The 10-year yield down about 11 basis points, its biggest decline going back to November of last year. So bids are a little bit, bonds are a little bit bid here. Let's see what goes on with that. Also interesting, we have warmer weather. I'm grateful for that here in New York, but it really is pressing natural gas down at 1 point below $4 for the first time since February. That's pressuring the utilities sector down 1.2%, because it's interesting, usually when yields are down, you would see utilities higher, but that is not the case right now in some of the natural gas companies. And then finally, Apple, right around that $2 trillion mark, market cap mark. It looks like maybe Apple is going to relinquish that, but you can see that the trading for Apple has been pretty brutal more recently. Right now, down 3.6%. Guy, folks really wondering whether or not this company can deliver iPhones, what the outlook is going to be like, even though they don't offer a formal outlook, but color from the company. And here is the chart of Apple. As goes Apple, so goes the market. You have to hope that Apple is going to hang on to its recent low for the market to not really fall apart.
Yeah, first day of trading already starting to look a little interesting. All those nice, shiny new P&Ls maybe starting to get dinged up a little bit already. It's going to be a bumpy year. Abigail, thank you very much in year. Much still to discuss on the political front as well. Let's turn our attention to Capitol Hill. Kevin McCarthy's chances of becoming Speaker of the House very much in doubt as Republicans prepare to take control of the chamber. The GOP will hold only a slender majority when the new Congress convenes, of course. Let's get the latest now from Bloomberg's Washington correspondent, Amory Hordern. Amory, when do the Republicans vote? What is the nose count right now for McCarthy?
Well, they're going to be convening around noon, Guy, and before you even have new members, because remember, this is a brand new Congress, and newly elected congressmen and women need to be sworn in. Before they do that, the first order of business, usually, largely every year, this is ceremonial. This year it is going to be filled with a bit of drama, and it's a bit of a fight. We don't know the exact vote count right now, but what we do know is that Kevin McCarthy is grasping for any votes he can have. If every single member shows up, he'll need 218. That is the magic number for him today, if all those members show up to get the gavel, to be the Speaker of the House. The issue he has is the far right of his party, and this has been an issue that has plagued the Republican moderate and centrist House members and those looking for that leadership role really for the past decade or so. This was what happened to former Speaker John Boehner in 2015. Right. 5 of these individuals say no. They are really the never Kevins. And then you have about 9 putting out a letter saying that even though Kevin McCarthy over the weekend gave into some concessions, one of them being making it much easier to call a no confidence vote on him and his being Speaker, if he was elected, they say that there still needs to be more specifics. Right. And he didn't give in. So at the moment, he just doesn't have the votes there.
Could he have the votes if he gives stuff away? Like, what would they vote for him for?
Potentially, but he can really only lose 4 individuals. It depends if some show up and maybe vote present, because we have seen in the past Newt Gingrich, Boehner, Pelosi also 1 year didn't get exactly 218, but got the majority. But there are individuals that just don't want it to be him. And so potentially what we will see here is that if he is unable to get this vote, now it's a roll call vote. It
happens once. Usually that individual's elected. It's been a century since it didn't happen in that way. But then they would move right away until a second roll call vote. There could potentially be a resolution to change some of the rules, or they go back to negotiations and we could see another speaker emerge.
Anne-Marie, really appreciate it. Thank you so much. Great reporting. We'll look forward to that throughout the day as well. Bloomberg's Anne-Marie Hordern. So let's dig deeper into that, what's hanging in the balance here, as Kevin McCarthy's making a bid for the House. So Terry Haynes had a note out over the weekend. He's head of Pangea. He sees this as a big threat on the horizon. He writes, our overall default scenario today rises to a substantial and non-consensus 40% by June. Markets negative thanks to political brinkmanship around whether the U.S. debt ceiling should be raised or suspended, the key to solvency or default. Let's get more on this with Henrietta Treyz, Veda Partners Managing Partner and Director of Economic Policy. Henrietta, are we going to learn something from this Kevin McCarthy debacle when it comes to Speaker of the House through to a debt ceiling debacle?
Yeah, I think you definitely have a lot to learn, and I would say that Kevin McCarthy needs a strong hand here. I mean, he's Irish. I'd recommend he call Roddy the Piper, have those 200 members that he actually has in his back pocket, march them down to the floor, and then see if another 18 will follow. The debt ceiling is an issue that's going to come up in the late first quarter. I anticipate Treasury Secretary Yellen would send a letter to Congress around then saying that we're about to start using extraordinary measures. And then historically, you get 3 to 8 months of functionality before you have to actually take the vote in the House. So getting McCarthy in early right now would be very constructive on him getting as much time as possible to sort of build up some goodwill with his caucus. They do not trust him. That's why there are those, 5 to 15 members who are on the fence about supporting him right now, including, as Anne-Marie just suggested, the 5 who are never Kevins. He needs to break one of those down. And if he does, investors, I think, would be able to take a little bit of solace in the idea that he can potentially find a path to yes on the debt ceiling come late July or late September if he's able to do this quickly. If it takes, well into the night or even a second ballot, that'd be the first time in 100 years that we have to go to a second ballot, and that'd be extraordinarily difficult and just harmful to McCarthy as Speaker. And I think, like Speaker Boehner before him and Paul Ryan just after that, it's likely to cost him his job eventually, if not immediately. So giving some time to deal with that would be in his best interest.
Henrietta, from a market perspective, good morning, Happy New Year, it's Guy. What is the worst case scenario here? How bad could it get?
I was just talking to some clients this morning. We're already at the floor in terms of expectations. I'm not expecting any legislation to pass under the House or Republican conference. They have a 4-seat margin. It's very, very difficult. We're seeing that he might not be able to get the rules package or the speakership claimed. So passing this super confrontational and contentious legislation is a really heavy lift. But what you want to see from the investment perspective is time. Give McCarthy as much leeway as he can between today's votes, maybe votes well into the night. There's been some speculation that this could take all week. That's a really long time in D.C. Getting into tonight would be damaging in and of itself. The first vote, as y'all were talking about earlier, is going to start around noon. It'll probably take at least an hour to get that first roll call vote. Every member needs to actually go to the floor, raise their hand, and say who they're going to vote for. My information suggests that every Democrat is going to vote for Hakeem Jeffries, so McCarthy really is going to need to get all 218 on his own from his own caucus. And it could take very deep into tonight, but speculation that it could go into later this week is sort of along the lines of that contested convention conversation we have every presidential cycle.
Yeah.
It's fun to talk about, but doesn't usually happen. So late tonight is really as far as I'm willing to go right now.
Henrietta, how and when should this be priced into markets?
Well, I think investors should already have a firm handle that nothing's going to happen this year except for the bare minimum, the must-pass stuff. So for market participants now, no matter what goes down with the speaker's vote tonight, I'm expecting a debt ceiling suspension to be agreed to either in late July or September. We do need to get a farm bill, so there'll be a fight over food stamps. That's usually a very big indicator for anybody in the commodity space, in the low-income space, the consumer retail space, because there are already calls from the Republican conference to slash WIC and food subsidy spending. Then there is obviously the need to fund the government into October 1st of 2023. So we'll have that fight later. But those are a couple months down the road, and we can already sort of predict how that's going to play out. It's going to be contentious no matter how tonight's vote goes.
Henrietta, Donald Trump supports Kevin McCarthy. why do these members, the Never Kevins plus the other 9, not support him if Donald Trump does? And what does that say about Donald Trump's authority within the party?
You bring up a really interesting point here. As you know, anybody can be Speaker of the House. So the speculation already is that if Kevin McCarthy has to go into the second or third ballot, they're going to start calling up non-members. There are a couple of names out there. Justin Amash put his name in the ring on Twitter this morning. Then you have some folks calling for, Newt Gingrich. But it is within the realm of possibility that Donald Trump himself could find a way out of becoming the presidential candidate and become Speaker. I mean, so Trump supports Kevin McCarthy right now, and I think that's been a hard-fought relationship for McCarthy, a hard battle to wage, especially in the wake of the immediate days after the January 6th insurrection. But there's a long way to go here. And the other members are looking for things like a vote on term limits, which are just not going to be agreed to. Things like the fair tax, and a handful of other policy items that they just do not have the votes for. You're not going to get a balanced budget amendment passed. So these are things that unfortunately push the Republican leadership to negotiate more closely with Democrats than to cater with those 5 to 15 very conservative Republicans who are effectively holding the party hostage with no chance of victory.
Wow.
Sounds
a lot
great.
of political volatility in all of that. Amazing. Henrietta, you paint quite the picture. Thank you very much indeed. Henrietta Trays, Veda Partners Managing Partner and Director of Economic Policy. It's going to be an interesting day for Kevin McCarthy. Coming up, mounting concerns over new strains of COVID as China reopens. How worried should we all be? We're going to ask Dr. Gregory Poland from the Mayo Medical School. He's the Director of Vaccine Research there. He's going to be joining us shortly. This is Bloomberg.
Keeping you up to date with news from around the world, here's the first word. I'm Ritika Gupta. Disgraced crypto founder Sam Bankman-Fried plans to plead not guilty to fraud charges today. He's set to appear in federal court in Manhattan after being charged with orchestrating a years-long scam at crypto exchange FTX. Two of Bankman-Fried's closest associates have pleaded guilty to fraud and are cooperating with the government. Germany is open to seizing Russian assets to help Ukraine rebuild from the war. That as long as legal issues can be resolved and allies are on board. Still, not everyone in Chancellor Olaf Scholz's government is enthusiastic. Finance Minister Christian Lindner is concerned that confiscating Russian central bank assets could create a dangerous precedent. And China is vowing to hit back at countries that place COVID travel restrictions on its travelers. A foreign ministry spokeswoman says some of restrictions lack scientific basis and were imposed for what she called political goals. The US, Japan and some other countries are requiring travelers from China to show a negative test before allowing them to enter. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Guy.
Ritika, thank you very much indeed. Let's take a look at, or closer look at how China's reopening is going and the concerns that are being raised about potential new strains of the COVID virus. Dr. Gregory Poland, Mayo Medical School Director of Vaccine Research, joins us now. Dr. Poland, thank you very much indeed for your time. It feels it's been an age since we last spoke, which is probably a good thing. But Happy New Year, nevertheless. We're all concerned about what is happening in China. We're watching it very, very carefully. Yet we sit here in London and New York and elsewhere, largely vaccinated. How worried should we be about new strains coming out of China and entering the wider world?
That's a really good question, Guy. And the issue is that we are seeing the emergence of continuing variants and subvariants, some out of China, some out of other areas of the world, that substantially evade our immunity due to prior infection or to vaccination. On top of that, people are acting pretty much around the world now like the pandemic is over. You rarely see the use of masks, for example, in the U.S. Making it even worse, we have no monoclonal antibodies now with which to prevent or treat infection. So we're down to 3 antivirals, 2 of which have limitations in their use.
So, Doctor, and that's a great point. I do want to get to that. But before we do, just on the variants, there's one that seems to be spreading here in the northeast of the U.S., XBB, and then there's the potential variants coming as China reopens. What do we know about these variants? How severe are they?
We don't know a lot about the severity in terms of disease. We do know that they are very immune evasive, meaning that any antibody you have from prior infection, and a lot of people who have been infected think I'm home free. No, they're not. And from prior vaccination, those antibodies do not protect against getting infected. Now, you do get protection against severe disease. And so what you're seeing with XBB 1.5, for example, is in just a couple of weeks, it went from 1 to 2% up past 40% of the new cases in the U.S. In the northeast of the U.S., 75% of the cases are XBB 1.5. So this is not good news.
So are you saying that we have not learned to live with COVID? Is that still where we are?
I think our relationship with COVID is dysfunctional, is the way I would put it. And what we're seeing is a consequence, really, of self-sabotage. We know what to do. If we could convince people to get immunized, get updated boosters, wear masks indoors with people who are not your family, we could dramatically decrease, not entirely prevent, but dramatically decrease the consequences of it. As it is, when you look over the last week, hospitalizations are up 8%, ICU admissions due to COVID are up 11%. Try to get in to see a physician out in private practice. It's almost impossible.
Why? But you say that these variants are going to avoid these immunizations. So why get vaxxed if it's not going to do anything? Shouldn't we be spending more time on therapeutics?
Well, definitely we need more time and money in therapeutics. That's an absolute must. But so what's the real value of getting a vaccine? It does boost your immunity such that if you do get infected, you're much more likely to be shifted toward the benign side of infection. That is, have an asymptomatic or mild case. If you don't get those vaccines and boosters, you're much more likely to be shifted, if you get infected, to a more severe case. So you look, for example, at deaths and ICU admissions, 3 to 6-fold higher risk if you are unvaccinated than if you are vaccinated and boosted.
What's happening with flu right now, Dr. Poland? I'm sitting here in London. We seem to have an explosion of flu cases alongside more COVID cases as well. Is this year a one-off where we see large numbers of cases for both of these? We know that we haven't had flu for 2 or 3 years because we've been isolating and wearing masks. Is this a kind of flu exit wave as well, and is it a one-off?
Yeah, I think it is, Guy. I mean, we periodically have, bad years, so to speak. This is a particularly bad one. It started early. It will likely last a long time. The good news is that it's an influenza A H3N2, which is well matched to the strain that's in the Northern Hemisphere vaccine. It doesn't perfectly prevent infection, but it does prevent the complications of that infection. So just as we predicted, this tridemic really has occurred. We've got a COVID resurgence, increased numbers of, and a surge of influenza A and RSV.
Yeah. Well, okay, so before we let you go, let's get your prediction for this year, because 2 years ago you told us on this program that we'd still be wearing masks in a year, and we all thought you were crazy. Now look at it. I'm definitely still wearing a mask all the time. So doctor, what's the biggest conviction that you have right now for this year?
I think that we are likely to see periodic surges of COVID, of course, influenza and RSV during the winter time. We are not out of the woods yet. We must invest in monoclonal antibodies and have a more logical approach to the use of antivirals. And we somehow have to convince the population we are going to have excess morbidity and mortality until we get people vaccinated and convince them to wear masks.
All right, Doctor, we really appreciate it. Always wonderful to get your perspective. Thank you very much, Dr. Gregory Poland, Director of Vaccine Research at Mayo Medical School. Guy, you're not wrong. Your pessimism is not unfounded. It seems to be another really tough winter that we're gearing up towards. I was going to call you Scrooge or something, but...
Yeah. I started the show saying I'm a bit concerned about this year. I'm beginning to feel that view may be a little bit more reinforced. We've heard about what is happening with the war. We've heard about what is happening with COVID. We don't know whether or not central banks are going to over-tighten. Yeah, I think there's a lot of unanswered questions. Let's put it that way.
Yeah, and apparently we should all brace for a terrible cold winter as well. All right, much more coming up. You're looking at S&P off by about 0.3%. Tech getting hammered down 0.7 in the NASDAQ 100. This is Bloomberg.
So for many European markets, it's actually day 2 of 2023 in terms of trading, and we're getting some quite significant outperformance from European equities. Look at this. Stoxx 600 trading at 434. We're up by around 1.5%. That is in stark contrast to what we're seeing on Wall Street today. Travel stocks are doing relatively well today. Luxury stocks are doing relatively well today. The euro is not doing relatively well today. So the dollar is on the front foot, which is interesting. Everybody's come back today. Most people are back at their desks, and already one of the consensus trades for 2023, i.e. a weakening dollar, is beginning to be called into question. The dollar is up quite significantly today. The euro is down. We're down by around 1%. Now that feeds back into the equity story. You've got a translated earnings narrative as well there. The other positive piece of news for Europe is what is happening with Nat Gas. Nat Gas continues to tumble. It is warm and it is windy. And actually, you've seen gas being added to German storage over the last couple of weeks. We're down by 4.86% on Nat Gas, which is fascinating. We're going to talk more about all of this coming up. We need to get a sense of what the risks are for Europe in 2023. Now, Europe definitely produced some of the big risks of 2022, namely the war in Ukraine, which nobody really called this time last year. Anyway, Scarlett Montgomery Koenig is going to join us from TS Lombard in the next hour. Much to discuss. This is Bloomberg.